Let's continue on with our show today with my guest, Mish Snyder. Mish is the Director of Trading Education at MarketGauge, coming to us from Santa Fe, New Mexico. Mish, it's a pleasure to welcome back. How are you?
I'm great. How are you, Dave?
Hanging in there. We talked before we went live. It is a challenging market, right? And it's a volatile market. There are a lot of movements, and I know a lot of people are just struggling to sort of get their feet under them as investors and just kind of get a sense of how do we put this into context? How do we understand what's happening? Your first chart that you shared with me, I think, is brilliant because it combines some of the key market measures that you track. Can you talk us through these four charts and what it tells us about the environment here?
Well, I know that you talk a lot about time frames, so I always like to step back because this time frame has been extremely important this year in particular, and this is the monthly time frame where you're looking at two moving averages, a 23-month, which represents about a 2-year business cycle, and then the green, which is the 80-month, which represents about a 6 or 7-year cycle. In all the years that I've been trading, I don't think I've ever seen so much emphasis on these two moving averages. And it's logical, right? Because we had 2021 way up, 2022 way down, and 2023 is still trying to sort it out. Are we going to go into an improvement in terms of an economic cycle? Or are we going to eventually break down under that green line or under the 6 or 7-year cycle, which would put us into a much deeper recession? And at this point, we don't know. But here's what we do know. Looking at the semiconductors, obviously that's being challenged right now. March doesn't end till the end of the month, so this is the mid-month. But nonetheless, we got through the Ides of March, and we're peaking out above that 23-month moving average in the chip stocks and the growth stocks and a lot of the FANG stocks. Now, that in and of itself would be like you, Dave, taking your family to Disneyland if you just look there. But there's other realities going on, and I think these realities have to be kept in the mind. And again, another brilliant point you made before I came on, which is really understanding your risk reward, right? So if we move to the right, then we're looking at the Russell 2000. Now, by now, people know this is what I consider to be the granddaddy of the U.S. economy because a lot of these chip companies have international presence. A lot of them buy back their own stocks. But these 2,000 stocks that are in the United States, they're small cap. They don't have the same amount of money as an Apple. For example, and they may experience layoffs, but it's not going to be like hearing Amazon laid off 18,000 people, which is just really a nothing compared to the size of Amazon. This really represents the economy. So look what is happening right now. It has not been able to get through the 23-month. And up until today, it looked like it was starting to challenge that 80-month. And how many times have we been in a situation where the chip stocks keep running only to look around and realize, whoops, the economy is in not such good shape, and everybody gets nervous, and then those start selling. So it's going to be what happens first. Does the confidence come back or not to the Russells? Right now, we saw a bounce today. Let's see what happens. But to me, this is really still very much trading range. If we move down below that, this is granny, retail, right? Consumer. 68% of the consumer, of the GDP is the consumer. So same kind of thing, almost mirroring the Russells, although in a little bit of a better shape because it's still above the 200-week, whereas it looked like IWM was going to test it. But again, with all of this confidence we're seeing in the chip technology, we're still not seeing a lot of money coming into the discretionary consumer space. Money's mostly coming into the consumer staples because people have to eat and they have to buy certain things, which of course then takes, and by the way, IYT transportation demand looks very similar. It actually broke the 200-week moving average yesterday when it traded at 218 IYT, came back a little bit today, but the week's not over yet, right? So tomorrow's going to be very interesting. And then finally here we have the regional banks. So again, the regional banks never ever took out the 23-month. And if you look at a weekly basis chart, by the way, it also started to break down under the 50-week before anything else did 3 weeks ago. If you don't think price tells you something, somewhere along the line there's somebody smarter than all of us reflected in the charts. This is a great example, right? So now we can see the result. So the question is this. I think you put this all together, and this is one of the more disjointed situations within our economic modern family I've ever seen, which makes it challenging, obviously, makes it optimistic, depending on where you look, but also makes it a little bit scary because the knee-jerk reaction into the big growth stocks partly has to do with the fact that it looked like, once again, the Fed and the government saved the day with the banks. But there's a consequence to that, obviously, because there's money being printed. So that's kind of really where we're at right now, looking just here.
It feels, to be honest, like the modern family is having a little family disagreement in some ways, right? You have the good, the bad, and sort of the indifferent, sort of the caught in the middle, right? And it's interesting when you look at the chart of the S&P 500, while it's chopped around quite a bit, really hasn't gone anywhere directionally in quite some time, right? It's sort of sideways, and it makes sense to me that you're getting sort of these winners and losers in the middles, but in the end, it's kind of netting out to a choppy environment, to be sure. You brought up interest rates, and of course, we've had a lot of a focus on the bond markets this week. Next week, we have the Fed meeting. When we're looking at your chart of the TLT, what does that tell you about the conditions now and what we should be expecting going forward?
Well, this is a daily chart, so now we've gone to a much quicker time frame here. And by the way, yes, with the SPY, we know 420 is a 23-month. With the Qs, by the way, it's 328. So we still have quite a trip to go to even get there. So that's something to keep in mind, too. But the TLT charts are very interesting because I saw your tweet this morning, which is what made me want to talk about this with you, because you're obviously looking at this very closely as well, as everyone should, with a Fed meeting coming up. And also, chip stocks and growth stocks do not like higher rate environment, and the rates were coming down. And then, of course, today now the opposite happened. The rates actually went up, or I should say the yields went up a little bit. So look what happened. You want to talk about a technical, beautiful picture. We got right up to the 200-day moving average. And like you said, nothing good happens under the 200-day. Today, nothing good happened in terms of the TLTs. But it's still holding the 50-day, which is great. But what's interesting to me is if we go below to the leadership chart, that red line represents the SPY, and it is still outperforming the SPY, which is more of a risk-off environment, number one. It's more indicative of a flight to safety in case of a recession. So the TLTs today told us, okay, we have to go down because look how great everything is. But ECB raised by 0.5% today, which was a shock considering the vulnerability of the bank. And if we think that maybe Powell will go in the same direction, then TLTs will obviously reflect that by going lower. And if they don't go lower and he still raises, we're going to see the growth stocks totally go down. So here we are, once again, dancing between Disneyland and a shop of horrors. Now, in the bottom chart, we actually have also a good performance by the TLTs. They are above the 50 and the 200-day, so there's a divergence, right? Because in this case, the 50 being above the 200 is bullish in the real motion or momentum indicator, while we're still not 50 above the 200 in the price. So that's kind of why I think the TLTs are going to be another key here to watch.
Can you talk a little bit, Mish, we have about 2 minutes left, but when heading into the Fed meeting next week, when you're thinking of positioning, when you're thinking about risk versus reward, do you have a general way that you approach a Fed meeting given the volatility, the excessive volatility, and certainly the uncertainty, the unknown about what's happening? Do you have a certain way that you try to approach that? Have a general narrative that you think is going to work and position for that, but just be ready for some huge opposite move coming in? Or what would you tell people that are still trying to make sense of a week like next one?
Well, I think if you start looking at every single Fed meeting that happens, you would go crazy trying to readjust your entire portfolio. So I think you actually have to look at the overall trend of where the Fed is going and listen to what Powell is saying. He is not dovish by any means. He's looking at labor. He's looking at PCE, not so much CPI. So that tells me right now that he still plans to stay the course in terms of rates, so that I don't think I would make any necessary adjustments, except for the fact that there's one other factor, and that is the dollar. Because the yields went up today, but the dollar went down a little bit. And I think that people are very complacent in terms of what the dollar is supposed to do. And I'm a little bit worried here. That's probably my most worrisome case right now for a lot higher inflation, is if the dollar continues to fall before the Fed starts catching up with raising rates. Stay the course is very different than becoming overly hawkish.
It's such a lot to try to think about. And a great guidance to think about the dollar chart, by the way, Mish. It's a really good place to leave it. It is so good to see you, Mish. Thank you so much for coming on the show. I appreciate you sharing some charts, particularly those monthly charts of the Modern Family. That was a brilliant way to try to make sense of this. Be well and stay safe there in New Mexico. We'll talk to you again soon.
Thank you so much, Dave.
That's Mish Schneider. Mish is the Director of Trading Education at Market Gauge, coming to us from Santa Fe, New Mexico. I love being able to ask someone like Mish how you approach a week like the next one. I know there's a lot of uncertainty. If you weren't anxious about what we might hear and how things might evolve because the conditions are so fluid, certainly the conditions and the events in the last week have probably not helped. But I think just thinking about, not necessarily trying to do a deep history lesson, but just focusing on the evidence, focusing on the weight of the evidence, and really listening to what we hear, and just trying to think about what those impacts might be, I think is really good suggestions, really good guidance from Mish Schneider at Market Gauge.